Hey, it's report week this week, and when we look ahead to tomorrow's report, it's really just all about the yield and what is the USDA going to throw at us in here on this yield estimate. This is the thing. In June, they had the corn yield at 181 and a half, beans at 52, and as we're looking at these estimates in here right now, they got a pre-report estimates around 176.6 on corn and 51.4 on beans. That drops us down around 2.7% on corn, but only 1.2% in here on beans from trend. What we're going to see tomorrow is really a big debate. I know all along we've been talking about how we think that these yields could be down as much as 3%. So what has happened on years when we've had extremely poor crop ratings, like we have right now in 2023? Well, over the last 25 years, there's really 2 years that stick out, but they stick out for different reasons. In 2012, it was a drought, and as you can see on the slide in front of us here, the June yield was 166 on corn, and they dropped it down to 146 in July. The bean yield went from 43.9 down to 40.5. Those were historical drops, with the yield dropping 12% on corn, more than 7% on soybeans. When you get to 2019, though, when we had poor crop ratings, that was because of the extremely wet spring. And as you can see, the major drop or the major change in yield occurred from the May to the June report, as things held unchanged from June to July. So if we look from the May to July change there, you had corn down around 5.7%, beans down around 2% in here. So as we head into this report, our thinking right now, given current crop ratings, the surveys that we're doing with producers, we think this yield could come down a little bit more than what is estimated. The other thing that really has our attention in here this week is the oats market. This is the front month oats, so we got July in front of us. The red line is at 450, but we put this red line out there at 450 as September will be the front month at the end of the week. It traded to 447 today. We basically have oat prices trading at a 1-year high. This tells us that there can be some support underneath the feed grain market. Maybe we're rallying on the dry weather through the Canadian prairies and up through North Dakota, but this oat market rally is quite impressive. Now, as we want to wrap up today, and again, we're kind of short with the report out tomorrow, our best guess as we're looking for yields is we think this yield should drop 2 to 4% on tomorrow's report. That would put a corn yield in a range of 174.2 to 177.9. That current estimate is about mid-range. If the bean yield drops off a similar amount, though, that would put us to 49.9 to 51. That's much lower than the current trade estimate. Our lean then is that this bean report could be a little more positive compared to trade's expectations. We also need to keep in mind ending carryout, as we had a stocks report at the end of June. But when we look at ending carryout, we also had those adjustment in acreage. We're probably going to get the USDA to keep our corn ending carryout below 2.3 billion bushels, but we're probably going to have the bean carryout above 200 million. We don't see the USDA moving outside of those ranges. The last thing is this bean corn ratio. Right now, looking towards new crop NOV to D sits at 2.7 to 1. We've had years, specifically in 2016, when this bean corn ratio got out to 3 to 1. Looking ahead, this ratio probably should be in the 2.6 to 1 to 3 to 1 as we move all the way into harvest. This drop off in bean acreage, the increase in corn really supports this ratio. Wrapping up today, does oats know? Can it lead corn? We'll see with tomorrow's supply demand report. We'll bring you an update then again. Have a great day.